For every central bank action, there is a significant market reaction. And with central bankers showing no signs of backing off from their willingness to venture into new and uncertain monetary terrain, how can investors capture the rewards and avoid the risks of investing in a world of extraordinary monetary policy? Joining me now to dive into this is David Kaufman, the president and CEO of Westcourt Capital, a leading investment advisory firm here in Canada. David, always great to have your perspective. So let's get your reaction to this. I mean, we're seeing, again, this movement towards more and more experimental, aggressive, I don't know, I'll leave it to you to characterize it. What does the investor do? How does the investor think about this, and how do you mitigate risk and seize opportunity?
Yeah, we're at this sort of inflection point where it's sort of like we're at this point where what happens if I pull this lever, and no one really knows, and that's sort of, it's an interesting time to watch the markets. It's a little bit of a difficult time to be a market participant because there's always a lot of moving parts during the analysis stage when someone's trying to place an investment. But when you overlay that with government intervention, with central bank intervention, with this enormous question mark, should I bet against Europe? Should I bet in the US? How is Canada going to come through the oil crisis? Even if you were able to have perfect clarity and real prescience as to what is going to happen, you wouldn't necessarily then be able to say, what if I overlaid that with negative interest rates? Something that I didn't even learn in school because they thought it was a complete fantasy.
Yeah, no, it is amazing. And I mean, what do you think of Stephen Roach, the former chairman of Morgan Stanley Asia? We were talking with him earlier in the show. He's saying really that there's a profound distortion now in asset prices as a result of these extraordinary interventions. Are you worried looking out there across different asset categories? And if so, what asset categories are giving pause for concern?
Yes, and probably you don't have to look any further than the U.S. because this experiment that they're now, say, seeing in Japan and Europe has been going on in the U.S. since the financial crisis, this expansionary policy. And it's a little bit like if you have a patient who has kidney failure and they have dialysis, and you have dialysis again and again and again. You don't really know whether the patient is cured or whether they're just require the dialysis on a daily basis to be able to function. It's not the same as saying, well, we had a kidney transplant, so everything is now fine. So you have this spot where, for the first time, we're not sure whether an indication that interest rates will go down means that, okay, that's because the economy needs a bit of a boost, or are they going to go up because the Fed wants to be able to lower them again if there's another crash? So what I'm getting at is that it's never been a harder time to be a trader. But if you're a long-term investor, I think that you can still look at fundamentals. And you talked about in the first couple of blocks about, well, what's it going to take for the actual economy to get better? And I think that's an excellent question because depending on central bank intervention to continue to work when we're in uncharted territory is, I think, a fool's errand.
Yeah. Now, you're interested and you do a lot of work around alternative assets, alternative asset investing. Is that potentially a way to kind of mitigate some of the bigger risks in terms of volatility that we've seen in equities and other more traditional asset categories?
I think it is, but because the driving force behind many investments is debt, the cost of debt and the availability of debt, not the same thing. A lot of people in the U.S. talk about how low interest rates are, but they're incapable of getting a mortgage, say, so it doesn't matter how cheap they are. So the cost of debt and the availability of debt will drive success, not just in the traditional sense, but also in a lot of alternative space. Now, that said, if one wants to sort of lower the volume a little bit, the amplitude of the volatility, there are uncorrelated asset classes, truly uncorrelated asset classes like timber or farmland, which, whose value truly has nothing to do with what the day trader in his pajamas thinks that, a certain share of some company is worth. Then that kind of diversification certainly will lower and dampen volatility, as will investing in private assets, because even though it's a little bit illusory, because they don't have a daily mark, you don't have this daily nausea brought on by the volatility that in no small part is caused by the central banks.
And then just finally, I mean, Chris Reagan was on, McGill economics professor, saying in a sense, we just got to wait this out. It's going to take 2, 3, 4 more years of this. We're slowly going to recover. Do you buy that thesis? Is it a question of waiting it out, or potentially does it get worse?
Well, the fixed income people that I speak to, who are usually the ones who are the best predictors of these things, say that they think that interest rates will remain very low for a very long time. That's good if you're trying to access debt, but that also means sort of the direct corollary to that is that most of the people who are handicapping the future believe that it will require low interest rates. So that means that the dialysis will have to keep on going on and on and on for us to continue to function the way we are. And with governments running enormous deficits and the debt growing at hitherto unknown rates, I don't see that suddenly we're going to wake up one day and say it's a new dawn where we don't need low interest rates. I think we're going to see them for many, many years to come.
So lower for longer from David Kaufman of Westcourt Capital. David, always great to have you on the program.